Hello, in this lecture we will continue on Chapter 6, Financial Statement Effects of Costing Methods. So you'll recall that we have just gone over the assumptions of costing methods, those being the first out method, the last in, first out method, and the weighted average method. Remember that these are assumptions. This does not necessarily follow the actual flow of the inventory. It's just an assumption of what that flow would be. If we did follow the actual flow and assign the actual cost, that would be specific identification. We would use these types of flow methods if we had generally smaller priced inventory and inventory that is homogeneous or the same in nature, and therefore it would be not cost effective for us to have a specific identification, but be more cost effective to have some kind of assumption. And of course, these assumptions that we make, there's pros and cons to any assumption that we make, and there are significant financial statement effects of whatever assumption that we make, and these are assumptions that we need to disclose to the users of our financial statements to tell them, hey, we're using this type of assumption method, and so be aware of the effects of those methods. The first in, first out method often has an assumption that the ending inventory approximates the current replacement cost in the first in, first out. That's because if we sell the first ones that came in, we're left with the latest ones on the balance sheet, and it's thought that those were the ones that we most recently purchased, and therefore they approximate the purchase price most accurately. In terms of the last in, first out, and we can think that it better matches the cost of the goods sold, because the things that we sell, if they're all the same nature, the current price of them is what we're actually buying them for today. So the things that we're selling at the current price, the cost of goods sold, would be the higher price, which is the first ones are the first out. Therefore, the cost of the sales is more in alignment with the current cost of the goods rather than the older cost of the goods. And then, of course, the weighted average is in the middle. It's the average between the two. Tax effects of the costing method. Of course, the Internal Revenue Service is very conscious of attempts to lower net income through a costing method assumption. So some rules that the Internal Revenue Service will have, and notice that the rules in the Internal Revenue Service are different than generally accepted accounting principles. So when we're making financial statements, we have to follow the generally accepted accounting principles. When we are going to the tax returns, which are basically a set of financial statements, we have to follow the IRS code. Much of the information will be the same, but the IRS code does have some other types of incentives besides just reporting accurately, which is generally the idea of the generally accepted accounting principles. Generally accepted accounting principles, the idea is to report as accurately as possible, to have a matching principle that's good as possible so that we can compare period to period, so that users of the financial statements can get the best, most relevant information. Those users of the financial statements, if they're publicly traded, will be oftentimes investors, the public. Therefore, we want to give very accurate information. The IRS may have different types of incentives. They may have IRS regulations that are there to stimulate the economy, or these types of things, which are not necessarily just there to report financial statements in an accurate way that would compare time over time. So in this case, of course, they're concerned about an abuse between the types of estimates that can be used that would lower net income for tax purposes and thereby lower taxes. So the Internal Revenue Service identifies several acceptable inventory costing methods for reporting taxable income. And they specifically say here, if LIFO is used for tax purposes, the IRS requires it be used for financial statement purposes. So when we think about the books, we often have to, because of the two differences in the tax code and the GAAP, we have to reconcile those. Sometimes we have to have basically two different reporting measurements for certain items between the two different methods. So they're saying here that we want consistency between the bookkeeping, generally accepted accounting principles, and the taxes. So if you use LIFO to report your tax returns, we want to see LIFO being used to report your financial statements. So that's a stipulation on the tax side. Consistency in using the costing method. The consistency principle requires a company to use the same accounting method period after period so that financial statements are comparable across periods. So there could be this assumption that we're going to pick whatever method will make us look best, if we want to look good, and whatever method makes us look worse if we want to look bad, and we'll just try to pick whatever method is working from period to period. And of course that doesn't work for under generally accepted accounting principles or the tax code, but back to generally accepted accounting principles. Under generally accepted accounting principles, we have the idea of consistency. The whole basis of the matching principle, the whole idea of having an accrual basis is so that we have a consistent reporting of revenue and expenses in a way that will allow us to compare time period to time period. So if we used LIFO for this year and we switched to FIFO next year, and we tried to compare net income and inventory on the balance sheet year over year, we would have inconsistencies because of the assumptions we made. So whatever assumption we make between the acceptable assumptions is appropriate, that's fine, but we need to be consistent over that choice and use that same choice over a long period of time, and thereby allow us to have financial statements that can be compared from period to period. If we compare net income from year 1 and net income to year 2, we want to see that the differences and the changes are due to the business doing better or worse, not due to changes in estimates that were being made. So the lower of cost or market. So generally accepted accounting principles are basically also going to have this idea, they call it an idea of conservatism, not to be like a political term, but conservatism being that we want to generally err on the low side, meaning we would rather, under generally accepted accounting principles, kind of err on the side of making our balance sheets and our income statement look worse than inflating them unnecessarily. And of course, companies want to look really good for financial statement purposes. When they report their financials, they generally want to look good, and that's because it could increase their stock price and whatnot. Again, for taxes, it's flipped on its head, but for financial statements purposes, we want to look good. And for generally accepted accounting principles, then the idea is usually don't get carried away with estimates that would inflate the value, because we are trying to look after investors on the public stock market, citizens, and we would rather have it erred on the lower side as far as a regulatory body than on the higher side for the most part. So, and that would be a conservative principle. So definition, replacement cost, not the sales price. So consistent with the conservative. Okay, so can be applied 3 ways. So we're going to have the lower of the market value. Inventory must be reported at market value when market value is lower than cost. So we can apply that 3 different ways. We can apply it separately to each individual item. That's a bit costly sometimes though. So if we had a lot of inventory, that might be costly. So another way we could do it is we could take the major categories of items and apply the cost or market in that way. And the third way is we can take the whole inventory and apply this method into the whole inventory system. So, for example, a motorsports retailer has the following items in inventory. So if we take a look at this, the inventory items, we got the cycle and the off-road, we have the number of units, we have the per unit cost and market, we have the total cost, we have the total market, and the lower applied to items. So in this case, we have the total cost being 160, the market being 140. Therefore, we are going to take the lower cost of market, LCM, or the 140. Then, of course, we've got in the sprint, we've got the 50 total cost, and the total market being 60. We're going to take the lower of the cost or market. And note that the general principle, of course, is for us to take the cost. So just remember that, if we bought equipment or something like that, we generally take the cost. And if we're talking about property, plant, or equipment, whether the price goes up or down, unless it was a significant change, we generally take the cost. But of course, in the inventory method, that's where we're applying this lower of cost or market method. If we have the off-road vehicles, once again, we got the 40 and the 52. We're going to take the lower of the cost or market being the 40. And under the Blazer, we got the 45 total cost and the 35 market. In this case, we're going to take the 35 market. Now, also remember that under normal pricing methods, we would assume prices to generally go up. So prices will often go up over time, and all else equal. When will prices obviously go down? If we're talking about things like off-road and stuff like this, is when the inventory is going to get old and somewhat obsolete. Then of course we're going to have to revalue it at some time. The market price will then go down at some point, and we'll have to bring them down. If they're homogeneous goods and they're all the same, the price usually will go up, all else equal.